Have you ever wondered what makes financial markets trustworthy? What prevents them from being wild, unregulated spaces where anything goes? It is a fascinating question that takes us back to a pivotal moment in financial history, when the very foundations of market confidence were in crisis. The Securities and Exchange Commission, or SEC, profoundly influenced capital market stability by establishing a framework of transparency, accountability, and investor protection. Formed in response to the chaos of the Great Depression, the SEC fundamentally transformed how securities were issued and traded, laying the groundwork for a more ordered and reliable financial system. Before the SEC's creation in 1934, the American stock markets were largely unregulated, leading to widespread abuses, fraud, and a significant lack of reliable information. This environment contributed directly to the 1929 stock market crash and the subsequent Great Depression. The SEC's role was to enforce the Securities Act of 1933 and the Securities Exchange Act of 1934. These landmark pieces of legislation mandated full disclosure for companies issuing securities and established rules against market manipulation and insider trading. The core mechanism was reducing what is known as information asymmetry, ensuring that investors had access to the same critical information as market professionals. Practically, the SEC influenced stability by requiring public companies to register their securities and file regular, detailed financial reports. This meant companies could no longer make unsupported claims or hide crucial financial data from potential investors. Furthermore, the SEC implemented rules for brokers and exchanges, demanding fair and orderly trading practices. This included measures to prevent excessive speculation and ensure that all market participants, from large institutions to individual investors, operated under a common set of enforceable rules. These actions fostered a sense of fairness and reduced the likelihood of sudden, widespread market panics driven by misinformation or fraud. An interesting historical detail is how the SEC helped institutionalize the concept of the informed investor. By standardizing disclosure requirements, the SEC effectively created the public framework for what modern finance often refers to as the efficient market hypothesis, where security prices fully reflected all available information. This level of mandated transparency was revolutionary, shifting the burden from individual investors to the companies themselves to provide accurate and complete data. Ultimately, the SEC's early interventions were crucial in restoring public confidence in capital markets. By bringing order, transparency, and accountability to what was once a chaotic environment, the SEC provided a stable foundation for capital formation and economic growth. This allowed millions of people to invest their savings with greater assurance, knowing that a regulatory body was actively working to protect their interests and maintain the integrity of the market.